Thinking about buying property in Australia? Before you take the plunge, there's something you need to know: property taxes. From stamp duty to land tax, Australia has a range of taxes that every property owner should be aware of. But what exactly are these taxes? How much do they cost? And what can you do to minimize them? Stick around because in today's video, we're breaking down all the property taxes in Australia, and the last one might surprise you: stamp duty. Let's start with one of the biggest property taxes that everyone faces when buying real estate in Australia: stamp duty. Stamp duty is a one-time tax paid to the state or territory government when you purchase property. The amount of stamp duty you'll pay depends on several factors, including the property's value, the state or territory you're buying in, and whether it's your first home or an investment property. Each state and territory has its own rates for stamp duty, which are typically calculated on a sliding scale. For example, in New South Wales, stamp duty starts at around 1.25% for properties valued under $100,000 and can go as high as 5.5% for properties over $1 million. Other states, like Victoria and Queensland, have similar structures with rates varying based on the property's price and whether it's for residential or commercial use. There are, however, some concessions and exemptions available, particularly for first-time home buyers. For instance, in several states, first-time buyers may be eligible for a stamp duty discount or exemption if the property's value falls below a certain threshold. This is part of government efforts to make housing more accessible, especially in cities where property prices have skyrocketed. Stamp duty is a significant upfront cost, so it's important to factor it into your budget when purchasing property. Unfortunately, unlike other taxes, stamp duty is non-deductible, which means it cannot be claimed as a tax deduction on your annual income tax return. Land tax. Next up is land tax, another major property-related tax in Australia. Unlike stamp duty, which is a one-off payment, land tax is an annual tax levied by state and territory governments on property owners based on the value of the land they own. The tax is applied to investment properties and other non-primary residences, meaning your own home is generally exempt. Land tax is calculated based on the unimproved value of the land, which means the value of the land itself without any buildings or improvements. The amount you pay varies depending on the state or territory, with each having different rates and thresholds. For example, in New South Wales, land tax applies if the total value of your land holdings exceeds $969,000 as of 2024, while in Victoria, the threshold is $300,000. It's important to note that land tax is a progressive tax, which means the more valuable your land, the higher the tax rate you'll pay. For instance, in Queensland, the tax rate ranges from 0.75% to 2.25%, depending on the land's value. If you own multiple investment properties, land tax can quickly add up, especially if the total value of your properties crosses the threshold in your state or territory. Some states offer exemptions or reductions for certain types of landowners, such as farmers or developers. However, for most investors, land tax is an ongoing cost of property ownership, and it's important to include it in your financial planning if you own or plan to own investment properties. Capital gains tax, CGT, is another key tax that property owners in Australia need to be aware of. CGT applies when you sell a property and make a profit on the sale. The tax is based on the capital gain, the difference between the purchase price of the property and the sale price, minus any expenses such as renovations or legal fees. However, not all property sales are subject to CGT. The principal place of residence, your home, is exempt from CGT, meaning you won't pay tax on any profit you make when selling your home. On the other hand, if you sell an investment property or a holiday home, you'll need to pay CGT on any profit you make. The good news is that if you've owned the property for more than 12 months, you're eligible for a 50% CGT discount. This means you only pay tax on half of the capital gain. The amount of CGT you'll pay depends on your marginal income tax rate, as the capital gain is added to your income for the year. For example, if you bought an investment property for $500,000 and sold it for $700,000, your capital gain would be $200,000. After applying the 50% discount, you'd be taxed on $100,000, which would be added to your taxable income for that financial year. Council rates. Another ongoing cost of property ownership in Australia is council rates. Council rates are local taxes that property owners pay to their local council to fund community services such as waste collection, road maintenance, parks, and libraries. The amount of council rates you'll pay depends on the location and value of your property. Council rates are typically calculated based on the value of the property or the land it sits on, and rates vary significantly between different councils. For example, properties in city areas may have higher council rates due to the higher cost of services, while rural properties may have lower rates. On average, council rates can range from $1,000 to $3,000 per year, depending on where your property is located. Council rates are an important factor to consider when budgeting for property ownership, as they are a recurring cost that property owners must pay every year. Failing to pay council rates can result in penalties, so it's essential to keep up with these payments to avoid legal action from your local council. Foreign investor surcharge. If you're a foreign investor looking to buy property in Australia, there's an additional tax you need to be aware of: the foreign investor surcharge. This is a tax specifically targeted at non-resident foreign buyers who are required to pay an additional surcharge on top of regular stamp duty when purchasing property in Australia. The foreign investor surcharge varies depending on the state or territory, but it can be significant. For example, in New South Wales, foreign buyers must pay an additional 8% surcharge on top of standard stamp duty rates, while in Victoria, the surcharge is 7%. This means that foreign buyers could end up paying tens of thousands of dollars more in taxes than Australian residents when buying property. The purpose of the surcharge is to discourage foreign investment in the property market and help cool housing prices, particularly in areas where demand from foreign buyers has been high. If you're a foreign investor, it's important to factor this surcharge into your budget when planning to buy property in Australia. So there you have it. Australia's property taxes explained. From stamp duty and land tax to capital gains tax and council rates, owning property in Australia comes with a range of taxes that you need to be aware of. Understanding these taxes and planning for them is essential to making informed decisions about your property investments. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more informative content about property, taxes, and investment tips. Let us know in the comments if you have any questions or if there's a specific tax topic you'd like us to cover next. Thanks for watching, and we'll see you in the next video.